Good evening, everybody, and welcome to our summer financial wellbeing and education webinar in partnership with Mattioli Woods. First of all, I hope everybody's enjoying the brilliant weather that we're having so far, and everyone's getting out and getting in the sunshine and spending time with loved ones. Big thank you to everybody who's been part of the live offering tonight. We really appreciate you making the time in your schedules to come on and really engage with the education that's being provided. There's a real benefit as well to an advantage of viewing the webinar live. You get your questions answered by the experts on the call in real time. So yeah, just a big thank you. Also a big thank you as ever to Adrian and Mark, who will be covering tonight's content for us, focusing on understanding our pay slip, tax, and also national insurance. So I'll hand over to Mark now and we can present this evening's webinar. Thank you.
Steve, thanks ever so much indeed. Good evening, everybody. Thanks ever so much, as Steve said, for giving up one of the most wonderful summer evenings to focus on your pay slip. But listen, it's important stuff. And for the sake of 30 minutes or so, I hope we can throw one or two thoughts towards you that you might think of taking them away and maybe checking one or two things. As ever, this webinar is part of the programme that's been organised by Rugby League Cares, and we're just adding now to a library of webinars that we've been delivering over the months, and you can find all of these on the player portal. The purpose behind this is we focus on financial well-being, but financial well-being supports our overall well-being massively. If we feel on top of things financially, it's one less thing to worry about, enables us to focus on other things like our physical well-being, mental well-being, and the like. So even if you feel your finances are absolutely on top of the world at the moment, always remember a few little jobs every now and then just to make sure that you can make a little bit more of a difference. Before we get into the detail, I'm just confirming the information in this webinar is correct at the time of recording. You can read it on the slide, I know, but it helps to just remind those who'd rather listen to it. It's correct at the time of the recording and delivery, and it of course relates to this current tax year 2025-26. Again, this is not financial advice, it's information to help support your overall understanding of your overall personal finances, and generically the way that finances, we can make a difference to them. As Steve was saying, we're going to look at the basics of understanding how pay works, and one of the big clues in this is your pay slip and the information it contains. And I have to say, pay slips, and we've come up with a real corker for you, not the most exciting document in the world, but within it you will find just about everything you need to, first of all, check what's coming in, check what's going out. But there are clues in there about, okay, does that deduction look right to me or not? And if not, what do I do next? And hopefully we'll touch on that as we go through. Clearly your payslip as well improves your overall financial knowledge, and your personal financial planning. So pretty important document, and I'll get into more detail on that as we run through. Again, Steve mentioned that, thank you for giving up your time, and you're blessed with having Adrian tonight, who's sitting in the background, but you'll see as you're looking on your screen to the right hand side, well, it is the right hand side for me, there's a Q&A section. Now, if you have any questions at all, mainly financial, I would guess, about any of the content this evening, or indeed anything financial, please use Adrian. He really is expert in all of the topic areas that we cover, and he will provide you with an answer in real time as we're going through the content. We're also going to pick up with Adrian, or I'll invite Adrian back at the end, just to see, are there any questions that have cropped up more than once, so that we can share those with everybody else. And okay, we know that this happens quite frequently. You're getting towards the end and something goes in your head and you think, oh, I'll just ask that one. And we haven't got the time quite to answer your question before we close the webinar down. Don't panic. We will email you directly, and we're going to be using the email address that you used to register for the webinar. That's the only reason we collect that. One, to let you in, but number two, to send you any personal information or answers to your own personal questions that you asked during the webinar itself. After that, we don't keep your email address. We get rid of it. So you're not going to get marketed and all that sort of thing. Don't worry about that. So let's start with a look at a payslip. Well, I'm going to just talk around this first because I don't know if those two people are looking at a payslip or not, but let's assume they are. As I said before, it's not the most exciting document, but it is vitally important because it's a record of what we've been paid by whoever we're working for the work that we've done. And it's one of the few records that even HMRC themselves say, well, you should be keeping these just in case we need to contact you with a query. And it does happen from time to time. So for whatever reason that HMRC, His Majesty's Revenue and Customs, to give them their full title, and let's revert to the initials after that. But they will come on to people individually from time to time just to query some information. They suggest, and can I say, if they're suggesting, I'd just take it as a rule. They suggest that we should keep our pay slips for 22 months. Now, I can't get to the bottom of why it's 22 months, but that's what I found on the website. I'd suggest you keep 2 years worth because it's just easier then, but keep 2 years worth of pay slips. I appreciate at the end of a tax year, you also get something called a P60, which summarizes all the payslip information. But the worst case scenario, you've got 2 years of payslips, you've got all your P60s, fantastic. Payslips generally are mainly monthly, but of course they can be issued weekly as well, depending on how your employer prefers to pay you. So this is our example of a payslip. Now, well done if you can actually read all of it, but don't worry, we've sort of taken it apart and blown up some of the examples. What's in it, because I'm hoping that each of you reads your payslip. Employers use different types of software, different payroll systems. So yeah, if you've moved around a couple of employers, you might start seeing some common things that pop up, but at the same time, it might look, in appearance terms, it might look a little bit different from something you've seen before. So do take a moment just to acquaint yourself with the way it's set out. A lot of the time, many people just look at the bottom of the payslip because that's telling you the amount of net pay, the amount of pay that's being given to you. And sometimes people don't even read it at all. What they do is look on their bank account, and if the amount that's been paid in there looks absolutely right, that's it. And worryingly, I think a lot of people never look at them at all. It is worth checking them. And quite frankly, the more often you do it, the quicker you'll become at it. So some numbers will stick out like a sore thumb if they look dramatically different from the previous month. And if that is the case, think, okay, what's the reasoning behind that? You can always talk to your employer and find out what the reason is. It's equally important to understand the breakdown of everything that makes up what we call the total reward for the job, because we don't just get things like pay. As an example, we're invited to join a pension scheme. Now, that's a great benefit because at some point in the future, I appreciate for many of you, I will be way in the distance. But at some point in the future, you won't be playing a sport, you might not be working, but you will need an income. And a pension or pension savings are one of the essential elements that are provided through employment that will support you in your later careers as well. So I promised we would expand on some of the content. And I want to start off with the tax code. So if you're visualizing this, look at the top line, and you'll see on the left hand side your tax code. This tells us how much our tax allowance is, and it's the amount that we can earn before we start paying income tax. Now, given that the taxman's after money, it's really important that we understand our personal allowance, our tax code, in other words, to find out how much we're allowed to earn before the tax people start digging the claws into what we're bringing home. Now, for most people, the tax code is going to be 1257L. So that's 1257L. And this relates to the standard personal tax allowance, which for this year, 2025-26, is £12,570. I don't know if you've picked up in previous budgets and what have you, but that's been frozen for a few years and it's going to continue to be frozen for a few more years. So if you don't see a change in your tax code, in other words, if it doesn't increase from 1257L to a higher amount, don't be surprised for now. The last digit in the code has deducted the zero. So 12,570 becomes 1257L. Now, for some of you, you'll be saying, well, hold on, I haven't got 1257L. And that could be a really good reason for that. And in many cases, it's because you might not have paid the right amount of tax previously. In other words, you owe some money to HMRC. What HMRC normally do is claw back the amount that we owe by adjusting our tax code. And what they should do, either before or at the beginning of any new tax year, remember that comes in April, but we'll go through the dates in a little while, they should contact you either through, they'll drop you an email to say open your tax account because there's a note in there about it, or they might even send you a letter saying, this is our calculation, this is what we believe you owe, this is what we've done to claw the money back. If you don't agree, the only way of changing it is get in touch with them. And whilst I appreciate there are challenges getting in touch with them, you can persevere and get in touch with them by phone or drop them a note or ask somebody for some help. Now, in this example, hopefully you can see it. You'll see that the tax code itself starts with an S. Now, this tells us that this individual lives in Scotland. Now, the Scottish government, one of the powers that was devolved to the Scottish government is that they are able to make changes to income tax. So you'll find that if any of you do move there, or indeed, I'm not sure that anybody will live there at the moment, but if you do, you'll know that the Scottish tax rates and tax bands are not the same as they are for the rest of the country. So the rest of the country being England, Wales, and Northern Ireland. HMRC need to know where you live. So one of the simple ways of doing it is anybody living in Scotland has a tax coding that starts with an S. Okay, if you happen to be living, so I'm in Leeds tonight. If you happen to live in Leeds or Wakefield or Warrington or Wigan or wherever it is right now, and you've got an S in front of your tax code, two things: you've either moved or the revenue have made a mistake. So get in touch with them. Okay. Tax code ends with an L. Now, the L means that you have the full allowance available to you. The full personal tax allowance is available to you. So remember, if you've got the full personal tax allowance, then you're not having to pay tax on the first £12,570 of income that you earn. Okay, what else can we see? Well, we can see the tax period, which in this case is monthly. So this person is getting paid on a monthly basis, and the tax month is shown up within it as tax month 06. So we know that we are sort of halfway through the tax year. On this slip, you should also be able to see your national insurance number. Now, your national insurance number is a unique identifier. And indeed, it's one of the few things that a lot of people can remember, for many, many years indeed. It's a unique identifier for all things to do with tax. And indeed, if you're trying to phone up the tax people, eventually you will get through. They normally ask for your national insurance number before they're going to start divulging any details. Now, this national insurance number will never change throughout our working life. Now, I say never, there are some fairly unique circumstances when your national insurance number could change, but they're highly unlikely to apply to any of us this evening. Now, finally, what else can we see on this section? Well, we can see the bank details. Now, that doesn't appear on everybody's payslip, but if it does appear on yours, cross-check it, but you should be seeing the money hit your pay account anyway. And there's also detail about annual pay and annual pay and the pay rate if it's being done on a hourly basis or something like that. Next section of the payslip that we've blown up. One of the key things that we're really interested when we look at a payslip, if we can get stuck into it, is both the income that we're being paid and what it's for. So we will see things like basic pay. We'll see things like extra payments. We'll see things like bonuses, perhaps win bonuses, whatever they are. But equally, on the flip side of things, we're also going to see things called deductions. They're the less attractive bits, but that's the money that's going out to settle our tax liability, pay our national insurance, maybe make a pension contribution, things like that. So vitally important that we're on top of it. On the deduction side, you'll see the value of both tax, national insurance, pension benefit, and student loans if you have them. Again, just check the details, make sure they're correct. Just a quick word on student loans if they're relevant to you. You normally start making student loan repayments from the April following the date that you graduated or you left your course. HMRC tell your employer how to work out and deduct the right amount, so there shouldn't be any problems on that front. Now, once a year, HMRC tell the student loan company what's been repaid, but you should be keeping your pay slips and your P60 as a record of those repayments, just in case you get challenged on this figure at some point in the future. So remember, you've got 2 years of pay slips, and you must keep your P60s, because sometimes people will go back a number of years. You'll also see the cost for things like your pension contributions. Don't forget, it's not just you paying into the pension, your employer's paying into the pension as well. So you'll see details of that too. National insurance, tax, any other benefits that are provided to you. Now, any benefits that are provided are going to be valuable. And even though they don't appear as take-home pay, you can see the cost of providing those benefits that are providing you with a little bit more peace of mind. So there is a value to these. It's just with some of them, you hope that you never have to claim on them or things like that. The pension scheme itself. Do make sure that you're in the pension scheme. All of us have to get offered a pension scheme. Now, okay, you can equally join schemes voluntarily as well. So if you've got any questions on that, do ask, or but contact details are at the end anyway. You can get in touch. But because you're in a pension scheme, your employer's paying into the pension scheme, and in some small way, the government is subsidizing it as well, because your contribution into a pension scheme are normally tax-free. Don't worry, we'll go through a little bit more detail on that. So do make sure you're in it, because if you're not in it, you're losing out. You're paying more tax than perhaps you had to, and you're not getting the contributions from your employer that they would normally make. Now, finally, at the bottom of a payslip, and to be fair, I think in many months, years, these are focused on it's the totals. That's the pay you before tax, total amount of deductions, and then finally cross-checking that the amount that's on the payslip is the actual amount that got paid into your bank account. So the final part of our payslip before we move into other areas, it's normally expressed as a summary. So it's a summary of the pay, the tax, and the national insurance that you've been paying through the year. Now, there are the odd occasions when you move clubs move employer during the course of a tax year. And in those situations, you will normally expect to see on your payslip, so the pay from your current employer, but also a summary of taxable pay and tax paid from your previous employer as well. Your new employer is getting that through your P45, but it enables them to check that they are making the right tax deductions on the pay that they're providing you with. So there's a lot there. And we thought it might be useful to go into a little bit more background, because we keep talking about tax, we keep talking about national insurance, but okay, what are the amounts and what are the limits and the like? So let's have a look at that tax, national insurance in a little bit more detail. And again, we're going to look at some areas that are to do with the tax year, and then a little bit more information that's around the tax code. And we're going to start on the left hand side of this slide, and we're just going to take a look at the tax year itself. First thing to say about a tax year, it's the same for the whole of the UK, whether you live in Scotland, Wales, England, wherever you are in the UK, it's the same tax year, and it always starts on the 6th of April and it ends the following 5th of April. Why it doesn't run on sort of 1st of January and whatever, I just don't know the history of that. Maybe Adrian does, but it's the 6th of April to the following 5th of April. I hope all of you are members of the pension scheme. I really do. And it's useful to know that your pension contributions, and of course the pension contributions from your club, your employer, are aligned to that same tax year. It does make an awful lot of sense, and it's very important, because whenever any of us make pension contributions, we should be getting tax relief on those contributions as well. Now, those living in Scotland, and I appreciate it might not be many of you who either are here tonight or indeed watching the recording, but if you are living in Scotland, the tax rates for Scotland are quite different to the rest of the UK. A lot more bands and different numbers, but that's the key thing. There's a lot of good information on the Scottish Government website on that. And final thing on the tax year, we all get a tax code each tax year. Now that tax code can change during the course of the year as well. So occasionally you'll get a notification from the revenue, either again in writing or perhaps telling you on your online account that you should open a document, have a look at it, because there's been a change to your tax code. The revenue will also explain why there's been a change to your tax code as well. So having gone on about tax codes, let's look onto the right hand column, and you can see there the tax code, and we start off with the letter L. Remember, that's the bit that tells you you're entitled to the standard tax-free personal allowance. So I would hope that a lot of you who are looking at your tax code are going to see the magic 1257L. Remember, that means that the amount that you can earn before having to pay tax is £12,570. Now, your employer, your club, are going to allocate that on a monthly basis. So they apply parts of your allowance through the course of the tax year. They don't stop taxing you for the first 3-4 months or whatever. They apply it in equal amounts across the whole of the tax year. There are some other sort of initials that pop up, and here's one that does impact some people. It's called BR. It means all of the income is being taxed at the basic rate. In other words, it's ignoring any tax-free personal allowance, because the person's already got or fully used up that personal tax-free allowance through other income or other employment. So this can happen sometimes when people run 2 jobs. Their main job uses their full tax-free personal allowance, the 1257L. So a secondary job that they take on may well be taxed at BR, meaning all the income is being taxed at the basic rate. M code, or an M suffix. This means that the person's got an increased personal allowance. It's part of the marriage allowance legislation. Now, be very careful with this. It's where you've got a married couple or a couple in a civil partnership, and one of the person who's receiving the increased personal allowance must be a basic rate taxpayer. Don't worry, we'll get into the numbers shortly. And equally importantly, the person who's transferring unused personal allowance is earning less than their personal tax allowance, 12,570. So it's somebody who's got very low earnings transferring some of their unused allowance to somebody that they're married to or in a civil partnership with, pardon me, who is still a basic rate taxpayer. And I think we've done Scotland pretty much to the nth degree, because remember, the Scottish tax code is that prefix S. Don't know if any other prefixes are going to emerge over the course of time. Let's hope not. Let's try and keep it straightforward as it is. But given that there are two different systems, I just want to highlight that the differences are really marginal, and they're focused very much on income tax. So if we start with national insurance contributions, that's a deduction that all of us pay. What it's paying for our entitlement to state pension, and it's paying for other benefits as well. Okay. Now, we're not going to go into the state pension in a big way, but it really is a very important benefit. Indeed, for some people, a state pension might be the only guaranteed income they'll receive in retirement. So it really is good to check where you are with that. Make sure that you are getting credit towards the state pension through either paying national insurance contributions or in some way qualifying for a credit towards your full state pension. The rate of national insurance paid by employees on earnings between 12,570 and 50,270 is 8%. Now, we'll get into all the numbers in a moment. So that's an 8% deduction for national insurance. Any earnings that you have above 50,270, the rate of national insurance reduces from 8% to 2%, but there is no cap. So, if you're doing phenomenally well in terms of earnings, you're still paying 2% on everything above 50,270. And remember, we're just talking national insurance here. VAT, levied at the same rates across the whole of the UK. So there's been no devolvement of the VAT rate there. Capital gains tax, it's the same everywhere. Capital gains tax is a tax on any profit that you make. So let's say you bought some shares and you sell some shares. It's a tax on the profit that you make. Hopefully you have made a profit. Should say on cryptocurrencies as well, you should be reporting any gains that you make. Maybe you've got a rental property. That is, you purchased a property, you're renting it out, you're getting rental income, and then ultimately you decide, oh, I'm going to sell that property. Well, there could be capital gains tax on that property, because the only exemption on capital gains tax with property is your main residence, where you live. Don't forget as well that the revenue are very keenly interested in the rental income that you might be receiving there as well. And then finally, if you do own shares, well, you may well be getting paid dividends. That's part of the reason we invest in shares. And if that is the case, then you do have a dividend allowance. That's £500. But everything above that is taxable. Okay. Now, I guess I should have told you that there is a capital gains tax allowance. Well, there is. And it's £3,000. So the first £3,000 of profit that you make in a tax year is exempt. After that, it's taxable. But that's where, if you are married in a civil partnership, a little bit of tax planning can come into it so that you can use your partner's allowance as well. So what's the difference? Well, if you live in Scotland, you pay the Scottish rates of income tax. That's it. That's the key. So let's focus on the UK rates of income tax. Remember, if you're getting the full personal tax allowance, the first £12,570 you're paying zero. You don't pay any tax at all. But then there's a fairly big chunk of earnings between 12,570 and, as you see there, 50,270. Any earnings falling into that gap there, you're paying tax at 20%. Congratulations if you're earning above 50,270. That's the good news. The less good news, you're now paying tax on those earnings in that band, 40%. And then it just gets tougher. Now, this is complicated, but for anybody who's got earnings above 100,000, well, for every £2 they earn above 100,000, they lose £1 of their personal tax allowance, which creates a unique tax band of 60%. That's 60% tax on any earnings falling between 100 and 125,140. After that, anything above 125,140, you pay a flat rate of tax of 45%. Now, I kind of focus at the lower end of the earnings there myself, but if you're doing some phenomenally successful things yourself, you've probably felt the pain already. But just be aware of that, and also think to yourself, well, hold on, what could I do to mitigate the damage here? More on that in a moment. But I just wanted to bring together tax, national insurance, and then we'll talk briefly about pension contributions. So, basic rate of tax 20%. Remember, that's between the 12,570 and the 50,270. And we also know that national insurance on those earnings, 8%. So in other words, total deductions, 28%. Now, you don't pay tax on national insurance on the first 12,570, but then you're paying 28% deductions on earnings above 12,570 up to 50,270. After that, once you get earning above that, and congratulations, you're now paying tax of 40% and national insurance 2%, 42% deductions. Okay, I'm feeling your pain all of a moment. Right. Remember, when you make a pension contribution, you get tax relief at your highest marginal rate. So if you've got somebody who's earning, I don't know, 35,000 a year, 40,000 a year, every pound that they put into their pension is only costing them 80 pence because they're getting 20% back from the government. Don't worry, the pension company sorts it out for you. If, however, your employer, your club, uses something called salary exchange or salary sacrifice, then you can also save the national insurance contributions on that pension contribution as well. In other words, same person earning 35, 40,000 a year, their pension, or every pound that they put into pension, could actually be costing them just 72p. That is a pretty significant saving. And remember, once it's in a pension, it's growing tax-free. And when you come to retirement in the far, far future, you can get up to 25% tax-free. And the balance, yeah, is taxable, but probably at a lower rate. So, yeah, do check. I mean, it really underlines the importance of being a member of the pension scheme at work, but also checking what type or what method of deductions the club uses. And if it does use salary exchange, sometimes referred to as salary sacrifice, the cost of putting the contribution in yourself personally is perhaps not as high as you thought it might be in the first instance. Okay, general principles are pretty much the same in Scotland, but it's a little bit more complicated working it all out. So what should you consider doing on the back of this? Well, first of all, dig out your pay slips, and I would say, just try and sort out the last 2 years. And if you haven't got them, fine, but you're starting from today, and you keep your 2 years of tax pay slips, and you're keeping all of your P60s whenever they happen. So it's not going to be box loads of information here. Believe me, it's a folder that will last you the rest of your life. What else should you be doing? Well, check your tax code. And if for whatever reason you think it's wrong, well, you get in touch with HMRC, who have to explain why they believe it's right. And then somewhere between the two of you, the correct answer will emerge. Sometimes it's them, but sometimes it isn't. So always query it. The tax bands for 2025-26, well, they're pretty much the same as they were last year and the year before. And next year, they're not going to change, but always keep on top of it, because we've got another budget coming in October. We haven't a clue what's coming, but it's an important thing to keep on top of. All of us have to pay a certain amount of tax, but paying too much or overpaying, never a great idea for ourselves personally. The third box there, look at your pension contributions and see how they could be used to reduce your tax liability. Now, that was a bit karaoke, but essentially, because saving towards a pension is subsidized by the government, you're not having to pay tax on those contributions. Think about, I might put some more in. Don't forget, being a member of the pension scheme means that your employer's paying money in as well. I don't want to over-egg the pension contributions, because remember, the earliest you can access a pension right now is the age of 55. And that's changing to 57 in 2028. So let's not kid ourselves. For many of you, that's a long, long way in the future. But the money that you do put in now is going to be the money that's probably going to work the very best for you, because it's the longer that the money is invested that you tend to see better returns. Time is your friend here. There are other things that crop up in the way. So having an emergency fund, having savings for holidays for this year, having putting aside money for a deposit on a house, they're all equally important. Hence the importance of, financially, just setting yourself the odd goal and then reviewing how you're getting on with these from time to time. Now, this make a diary note, going through it all every year, it's something we should be doing on a fairly regular basis. As life changes, it's okay, how does that impact the plans I've got now, and what should I be thinking of for the future, and the like. Remembering, of course, that anything that we can save now is going to help that little bit more for the future that we've got. So, questions. I'm suspecting the level of questions might not have been the highest, given the weather that we're fighting against, and the content. I know it's not exciting, but believe me, it's important. Aid, though, can I ask you to join back in and say, or explain if anything's popped up, or if you want to restate some of your favourite moments?
Well, you actually asked a question of me earlier on, which is why the tax year runs from the 6th of April to the 5th of April every year. I didn't know the answer, but Google knows the answer. And that's apparently was set in 1752. It's to do with the Gregorian calendar, but for you and I, it's mostly based around farming and property contracts, which tended to start before the harvest, around the 5th of April each year. And so that was when the tax year was decided to start and end. So you learn, every day's a learning day. So thank you for calling me out. I do know the answer to that now. There haven't been any questions on the way through, but the only thing that I wanted to add to the end of the presentation is that it's very common for players to, and you've mentioned it on the way through, very common for players to receive a win bonus. And what happens with the win bonus is that the money and the deductions are reported to the Inland Revenue, and then they think that you've received a pay rise. So you're going to be receiving that money every single week or month, however frequently you're paid. And so they'll adjust your tax code in order to take more tax from you, because you are, in theory, earning more money on a regular basis. And then, of course, you aren't paid a win bonus on the following pay slip, but there's more tax being deducted. Now, that's really common. So the one thing that you did point out is to regularly check your tax code on every single pay slip. That will highlight to you if a change has been made. And if you need any help and assistance with that, then you can come back to us, as players have done in the past, and we'll help to unravel the situation. We can't ring the Revenue and Customs for you. You have to do that. But we can certainly give you the facts and help you with what to say when you are talking to them, so you can get any overpaid taxes back. But other than that, there's nothing further to report at the end of the session.
well, getting overpaid taxes back is always a high point to finish with. Those of you watching the recording, you'll see my email address there. And yes, I will be sharing your emails with Adrian so that you're getting the full-blown answer to everything. Don't ask about the Gregorian calendar. I don't know what that one is, but at least we all know why it's April, something to do with farming. Listen, thank you for giving up your time, either in attendance during this recording or for those of you subsequently watching it. Don't forget to get back onto the player portal for any of the webinars that you've missed. All of it's useful and all of it's there to support you in your career, your finances, and the like. So we're looking forward to talking to you again in the not too distant future. But for now, enjoy what looks to be quite an interesting summer. Success, look after yourselves, stay fit. And yeah, we're very much looking forward to speaking to you again in the next few months. Take care for now and bye-bye.